blocks are really important because these are the elements that we plug into a recapitalization. The senior debt market, which predominantly for transactions like this is bank financing, is pretty robust. There are banks across the country that are very attracted to middle market opportunities like this. Bank financing, as I pointed out here, comes with asset-based type lending, meaning that there's a secured interest in the fixed assets, perhaps short-term assets of the company. And then there's also cash flow lending, which is much more scaled to EBITDA leverage multiples. And so like the 3x4, which is a typical capitalization strategy, is 3 times EBITDA for senior and then 4 times for total. So that means that the difference between 3 and 4, the 1 times, would be mezzanine capital. And then, as I just mentioned, there's mezzanine capital, which is a spectrum as well, and it covers transactions with sub-debt, subordinated debt, with PIKs on the extreme low end, if you will, on returns, through mezzanine debt with equity and or warrants on the other end. And then same thing with equity. The equity markets have evolved a little bit. Private equity funds sometimes will do minority transactions. Many times we'll do control transactions. And so it's really up to a good advisor to find the equity groups that can do the minority transactions for recap transactions. And so the one thing that I would suggest as well on the bottom is just the cost of capital. You know, basically senior debt is the lowest form of cost of capital. And so when building a capital structure, you should try to use the least costly the most if you can. Mm-hmm. And so, you know, use as much senior debt as you can, but if you can't fulfill the need with senior, then you've got to resort to mezzanine and then eventually to equity. But you're paying a higher price as you go from senior debt to equity. And then likewise too with growth strategies, debt is a wonderful, cheap source of capital, but with it, it carries covenants and it's somewhat limited. And so if a company has a lot of growth opportunities and does do a transaction or a recapitalization transaction, they might limit their growth opportunities in the future. And so again, you have to carefully consider the various building blocks so that maybe if you have a lot of growth opportunities, but you still want to do a recap, you might have to migrate more toward mezzanine and equity, even though it's more costly just to accommodate.
I was going to say, I know we received a question about asset-heavy industries and then how that factors in, or if there's any particular characteristics we should be aware of.
So in the ABL market, the asset-based lending market is ABL. Frequently, when you look at metrics such as 3 times debt to EBITDA as being a leverage limit, if you have a lot of assets in a business, and if it's a big manufacturer with a lot of plant and equipment, frequently you can go and get a secured loan that may exceed the 3 times cash flow number. And so asset-heavy companies can sometimes be better borrowers, if you will, in the asset-based market than they can in the cash flow market. Now, as companies mature, you always want to get more toward the unsecured borrowing. It's less limiting covenant-wise. It's less limiting in just following up with borrowing-based certificates and the like. So you'll eventually want to do that. But sometimes in middle market companies and smaller companies, in particular, the ABL market's a good thing. And so having an asset-heavy structure, I think, works or will work well. Mezzanine debt has fewer covenants, but still has covenants. And so there's more mother may-I's, if you will, in their lending agreements. And so the closer you get to the equity, the better you'll be with flexibility for growth in other avenues as well.